This podcast is intended and contains general information on financial strategies, investments, and products only. Whilst Luke and I are both licensed financial advisors, we don't know your personal circumstances, goals, or objectives. We highly recommend that you reach out to your financial advisor or investment professional to discuss any of the topics that we've covered today before taking any action. Our full disclosure, copies of our financial services guide, and additional information about Seneca Financial Solutions and Bold Wealth can be found in the show notes.
Hello and welcome to another episode of Wealth and Toil. My name is Luke Laretive and I'm from Seneca Financial Solutions, and I'm here today with my partner in podcasting, Dylan Pargiter-Green. DPG, how are you, mate?
Mate, I am excellent. I'm cold. It's a whopping 9 degrees down here in Hobart today, but we're getting through it.
Mate, that is your fault for living in the most southern state and the coldest part of Australia, so I feel no sympathy for you at all.
Mate, you live longer. You live longer if you live in the cold. That's what Wim Hof told me.
Here we go. We're going to get the
Iceman.
Is this going to be an episode about crystals and
absolutely.
sage cleansing? I think it is.
Yeah, no, definitely. You have to listen to my other podcast on that, but I can't cross advertise. So.
Right, no cross advertising without prior prepayment for all the future sponsors out there. Okay, look, let's get down to business, I reckon.
Get straight down to business. No, how's your week? No anything.
No small talk today. I don't really care about your week. And
we have spoken pretty much every day this week, so...
Yeah, no foreplay today. We're getting straight down to getting down to action. So we're going to talk about some of the factors that go into the stock market. Like, it's a bit of an academic topic, but we're going to do factors, and we're going to talk a little bit about probably what we've sort of both agree is the most popular factor among fund managers, and it's even popular among me. And so why we use quality as a factor so regularly and how we use it, and maybe a couple of relevant recent examples, shall we say?
Yeah, that's it. That's a good way of putting it. I mean, like these factors, I think, in our industry, they're thrown around a lot as terms for fund managers to suggest that the way they invest is different from someone else. And they'll potentially say that they are a certain style, but they do, I think, get used a little bit too much in providing a definition of what the fund is there for, rather than being a true representation on the underlying stocks that they're trying to invest in.
Yeah, I think you're right, and I think also from an academic perspective, there is the school of thought that is that that a fund manager, even active manager's style dictates their returns, and you should just invest in a highly diversified portfolio of that style. So, say for quality, growth, value, or momentum are the traditional sort of farmer French
spoilers,
farmer French factors, and farmer French factors, and that maybe drives returns more so than determines performance more so than individual stock selection. Look, I think that's personally is overcutting and over dicing. If a manager has a style and it does well, great. It's much who's to say that's just because the manager has biases. That's what you pay a manager for, is for their biases. So getting down. Oh, go on, Dill. You go, mate.
No. So, I mean, like, I have a couple of these questions that we might start with, because they are things that get thrown around. And I think all of these names, these names of factors, all have very positive connotations. I mean, quality is a good example. It's like, who doesn't want something that is good quality, right? If a business isn't quality...
That's the sales jargon. That's the trick.
Yeah, but if a business isn't good quality, it shouldn't be on the bloody ASX. Like, get it out of there.
Yeah.
The reality is that's not what quality is, though. And I think you're going to help us understand that a little bit more. No investor is going out there and looking to degrow their stocks, to shrink their value.
Yeah, or they're looking for stocks that don't offer value, or
Yeah, or I mean, maybe momentum's the outlier there, because
ironically about momentum. So momentum is one of the more persistent, behavioral anomalies in global exchanges. So, whilst it's not the rule for everything, it trend and is your friend. And there are a number of, I would say hundreds, maybe even around the world of trend following strategies, and they're that some of them are at a stock specific level, others are more at an index or commodity price type level, and there's a whole industry built around trend following strategies called CTAs, and I think it's underappreciated by a lot of investors just how important momentum can be at different stages, and when it is working for you, it can be a powerful generator of alpha. So
100%. But the biggest problem with momentum is the thing that most investors fail with, which is jumping off that train.
Yeah, and I think that's probably
that's how
more
people fall away.
Probably more a factor of being able to identify an uptrend and not a downtrend, or being able to put that momentum in the context of a wider narrative around valuation, around catalysts and announcements if you're talking about stocks, or around the flow of global capital when it comes to indices and sort of larger, more liquid markets than anything else. And when I talk about trend following strategies, we are talking about quant strategies, i.e. often high frequency trading, often systematic computer based strategies.
So let's then actually spend a few minutes breaking down each one of these strategies and give a 30-second spiel on what they are and what they try and achieve, because I think otherwise we're going to end up talking about probably everything. Too much jargon and be here until midnight. So let's do the big one at the start, quality, because we're going to spend the most amount of time on that. We'll start with that, and then we'll come back around, talk maybe some specific stocks. What is a quality factor when you're trying to pick stocks?
Well, I think broadly speaking, you're talking about a business that is able to grow their earnings without growing their shares on issue. It's probably the simplest way to describe it. So
I don't think that's the simplest way to describe it, but
well, I mean, if we think about a company, right? A company is some shares that are on issue, and each of those shares is worth a certain dollar value, and the dollar value multiplied by the number of shares on issue is the valuation, the market capitalization of that business. So when you buy a share for $100 a share, you're not actually buying $100 a share. What you're paying is for a share in the business, which is valued at, so there's however many shares on issue in the market cap. So I think that is the crux of quality. Now, how do we, I suppose, break that down maybe one more level? We talk about low debt and low debt to equity, and not having a lot of gearing on the balance sheet is a typical quality factor that we would consider. That's because we don't want the business to be using debt to grow their earnings. We want their business to be using organic growth to grow their earnings. That's what quality is. By the same token, if the company's issuing shares, constantly doing placements, constantly raising money, that is also a sign of a lower quality business, because they're unable to...
Dilution, right?
Dilution. Well, aside from the impact on shareholders, if we're just talking about a definition, then you would say that's a lower quality business. By the same, along similar lines, if a business is constantly acquiring other companies and can't generate growth from their core business, from their underlying competitive advantage, you would argue that this potentially is a low quality business. And I suppose the other thing that people consider as a bit of a catch-all, which sort of represents what I've been talking about, are these return on type metrics. So an ROE, return on equity, return on assets, return on invested capital, return on cash flow, return on invested capital. These sorts of things that we talk about probably beyond the scope of today's podcast, but calculating these metrics historically, forecasting where business are going to fall in the future, how that lines up with their overall strategy and moat in the marketplace. These are sort of quality type factors that fund managers who focus on quality have an overwhelming bias towards businesses that trade in that way versus other ways, which can also make money. There's lots of ways to make money. It's not that quality.
Well, we're
only
about
makes
to go
money.
into the other three factors,
Yeah.
and you've just spent half of our podcast talking about
Well,
quality.
that was 5 minutes. So.
No, you're dead right. I mean, I would say that the other thing, the main thing that comes up when we talk to quality managers is the level of free cash flow within the
free cash flow
business,
yield,
which means low debt, means they're making money, and it generally means that they're not paying out significant amounts of that money as dividends. They're keeping it, they're reinvesting, and they're aiming to grow. Yeah,
and I mean, if I've got a business that's operating on a 30% free cash flow yield, well, it means every dollar of profit that I generate, 30 cents is there for next year to reinvest in that business. So, then I'll have $1.30, and then it'll compound and compound and compound at 30% per annum. So
it's pretty good compounding rate.
Why would I pay you out a dividend for you to then go put it in the bank at 4.5? Mm-hmm. So I think when we talk about dividends and we talk about quality businesses, dividends, whilst they can be a indication of quality, typically businesses that we would consider high quality businesses don't pay large amounts of their free cash flow out every year as dividends. They've got a payout ratio of maybe 50 or 40 or 30%, and they will. I think you'll find that high quality business correlates with dividend growth more so than absolute dividend yield or absolute dividend value, because they don't have typically they're growing businesses, and we associate dividends more with mature businesses with slower rates of overall growth, and less moat and more competition and lower chance for continued reinvestment in that business.
Yeah, for sure. All right, well, let's spend a little bit less time on the three others, because we are going to talk about some specific stocks that are in that quality space. So growth, tell us a bit about growth. What's the lowdown on the frothy nature of these types of investments?
Growth investing is by definition buying businesses that are growing, and often businesses that are trading on relatively high valuations, because they are pricing in that growth for the future. You got
to remember
typical tech business is a good growth business.
Yeah, markets are forward looking, and a lot of these tech businesses don't make a lot of money in the first 5+ years of their journey. But they have a steep ascension if they do well.
Yeah, and most businesses that can grow rapidly are able to eventually manage their way to profitability, and usually increasing profitability. Over time. The knack is to be there when those businesses are growing and funding their growth through self-sustaining, shall we say, methods, and not be diluted and not be constantly putting your hand in your pocket to support that growth. Particularly if it's the dreaded death spiral of constantly raising capital and market in a falling market cap environment. So it's not to say that all growth businesses are unprofitable from the start, though. They are. I think it would be fair to say that most are.
Most are, but not all.
Most are, and I would go further and say that because they have such a good growth opportunity, they would be deliberately break even or unprofitable, because you're trying to take as much capital that you have and deploy it to the opportunity set in front of you
for growth.
Now that doesn't mean that they're unprofitable necessarily, but they're probably less profitable than they could be, because they're employing people, they're buying stuff, they're investing in marketing, blah 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 blah. So growth investing and growth investors and funds that focus on growth don't necessarily have any better returns than quality or value or momentum funds, but certainly chase a different style of business. And from my perspective, I think you'll hear about the most common type of growth fund is GARP, G-A-R-P, which is growth at a reasonable price. So it is a valuation disciplined way to gain exposure to growth. I think all good fund managers have a GARP-ish type vibe to them. And I think, from our perspective at Seneca, whilst we do own stocks that we'd consider to be value ideas, we have bought momentum things in the past. Most of our ideas would fall into a higher quality sort of tilted growth investment.
For sure.
And typically on the ASX, that's where you get your best bang for buck and your biggest returns.
Would you say that a lot of the alpha that's being generated in these funds is from, say, one or two out of a 10 company portfolio? So say you have
that's how funds management works still. So if you want to talk about returns in the absolute, you'll have of a 30 or 40 stock portfolio, you'll have 10% that generate a large portion of your alpha. And really, everybody has that 10% in their portfolio. The question is how do you manage the other 90%? And how good you are at not losing is probably the right way to describe it.
That's
not underperforming. So
but there's more losers in a growthy fund because you find that you're dealing with unprofitable companies.
I think it's particularly if you go down to say like venture capital style investing, which is a sort of private, slightly riskier version of typical sort of listed equity growth investing. But look, just think of any of the WiseTech's a really good example of a growth business, right? On the ASX, it's grown via acquisition, it's grown via organic growth, it's grown via industry growth. There's lots of opportunities for consolidation and continued growth in that sector. And WiseTech have been able to gain market share and grow their business faster and better than everybody else. And now they're the dominant, one of the dominant players in that market. So I think you could make arguments about the quality of that business. I would argue it's not a high quality business, but it has grown and has performed very well. And so that's a good example. Whereas something, say, like Adobe in America, I would argue is a very high quality business. And the reason why is because it is the system, the operating system that all artists and graphic designers get trained on. So the chance of them changing their system is low. It's like me. If you said to me, Luke, you stop using Excel, I'd be stuffed. People send me Google Sheets, I just delete them.
You can open them.
No, I don't. I refuse to open those. Trash, right? So that you would think of that as a strong moat, and as a result, they've had very high returns on capital. It's lots of recurring revenue. They're more quality type sort of features. Yeah. So anyway, we push on, Dill. We'll go to the next one.
Next one is probably the opposite of growth, and that's value. So everyone wants to buy something that's good value. Everyone buys on sale.
Warren Buffett's a value investor, so that's what I'd want to be.
Gee whiz, he does some things pretty well.
Like everyone who knows me knows I'm a bit of a closet Warren Buffett hater. So we can maybe have that conversation another day about why Luke
let's
Warren Buffett's overrated.
Let's do a podcast on
that'll really get the
10 things I hate about Warren Buffett by Laretive.
That'll really get the boomers going. So now sorry boomers.
Sorry Warren.
Yeah,
if you're listening.
Warren, Warren, JB, all my favourite boomers. So the thing about value is I think that all fund managers, as I said before, growth at a reasonable price. That's kind of like a value tilted growth. But a typical value investor is somebody who will buy a company that is in distress, a company that is perhaps in an industry that is in decline, has been structurally challenged, and they will see that the sum of the parts of that business perhaps is worth more than the whole. So I think that's where value investing really falls. It's more about being able to identify when the markets have got overly bearish on an entire business when in reality there's parts or the sum of the parts of that business perhaps is worth more. I'll give you an example of a value idea that I've been banging on about of late, that looks like a growth business because it's doing 30% per annum growth, but it's actually a value investment idea, and that's Webjet. So,
You've been big on this.
I have been big on this, and it's been going really well for me. So I can get on the horse soon. I'll be on the soapbox soon enough. Don't worry about that. But my point here is that this is a business it's an online travel business and a B2B travel business, and the value of the B2B, or the scale, size, and growth of the B2B business has been sneakily kind of growing in the background, doing amazing things while everyone's been focused on COVID and are we going back to travel and blah, 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 and the normalization of earnings in these travel businesses. And as a result, everyone's kind of forgotten that they've created this much higher quality, much faster growing, much better B2B business now inside Webjet called WebBeds. And when we compare that to businesses that look like that around the world in a valuation perspective, we think the 1 + 1 is actually equal to 3. And now the market's pricing it like it's old Webjet, online travel agent, not worth a lot. Sure, perfectly fine business for someone to buy and own and operate, not an issue. But the management team have also identified this now, that they're getting mispriced. They're not getting fair value for this part of their business. And they've announced that they're going to consider doing a strategic review and a spin out of these two businesses, or breaking Webjet up, so to realise this value for shareholders. And I think that is a good example of a growth business, typical growth business. But the reason we're investing is as we're actually doing a bit of Warren Buffett, and that's a value investment for us as a fund at the moment. So I think there's other examples that have done well. I would point to, in our industry, Bravura, which do midwinter, like the X-Plan financial planning competitor. I always say Bravura Solution, and BVS is the code for it. Iris in our industry, who provide X-Plan and Iris Pro, the trading software. These are businesses.
That's a business that you could buy at a significant discount right now.
These businesses have been they've been trashed, right? Stock's been trashed. And everyone's in there looking for a value idea, saying, hey, these guys have got fairly good market positioning. They're in a growth sector. They've got high value customers that are generally monogamous to them and they only use them. There's not a lot of competition in the sector. They're not competing with big tech yet. Maybe if we can get better management teams in here, or provide them with some guidance, do a bit of activist stuff, blah, 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 which is all above my pay grade. I'm not that fancy. I'm just a bog standard fund manager, but there are managers out there doing that at the moment, looking at those kind of businesses. And I think I don't necessarily disagree with them. I don't think it's not something that I'm investing in personally, but certainly it's interesting to me from an academic perspective. And they'd be good examples of value style investments on the ASX, where there could be more value in those businesses than is currently represented in the market capitalisation.
Yeah, no, agreed. All right. Well, the last one, you already did talk a little bit about this. So, momentum, right?
Momo.
Look, trends do pop up, and they can be wonderful things to jump on board. But I think, like what I said earlier, you, as an investor, you need to be prepared to jump off that wagon before that trend stops being trendy.
Yeah, I wouldn't think that the average ComSec investor at home, self-directed investor, should be trying to exploit trend.
I would argue that a lot of those individual retail investors on your ComSecs and superheroes are generally trend,
just following trend. Yeah.
Risk trend based investors.
I wouldn't be doing that. But look, trend is what it has performed well. Will continue to perform well. It works till it doesn't, and there are better ways to exploit momentum, in my opinion, than trying to do it on an individual stock basis. And most of them are sort of systematic and need to be applied systematic across the board to everything all the time at the same time to be able to properly exploit them. And you need to probably be able to make money both ways. Is my other thing. I think you need to be able to make money on the uptrend and on the downtrend. So, that requires a level of sophistication, I think, that probably most people don't have. If you want to talk more about some of the factors that go into trend following, some of the technical kind of techniques that people use, and Gavin Duckett, who works for us, is one of the best trend identifying quant analysts that I know. He actually ran a quant based trend following strategy for a number of years and still runs it. Actually, it's performed. It's one of the best alternative strategies I've ever seen in terms of risk adjusted returns and Sharpe ratio. So look, I think that there's certainly alpha, and particularly if you're talking about alpha on a risk adjusted basis, to be had in trend following strategies. But I would just argue it's difficult for the average punter to get much joy there chasing momentum. Certainly can be an input into your process. And I think what would be more relevant is things like earnings momentum, fundamental momentum. So being able to identify a business paying down debt, being able to identify a business cycling off a high period of capex, being able to identify a business whose earnings are accelerating faster than their peers. Those kind of momentum factors, I think, are really, really relevant. We use them every single day at Seneca.
Yeah, that's a more specific version of momentum than perhaps the
not price momentum.
General factor, and it's not trend following. You're not buying I don't know, crypto ETFs not because you believe in crypto, but because you believe other people will. That's the sort of momentum that we see
100%,
probably a lot more in retail, or not even small investors necessarily, but people that are trying to do it themselves. Sure. And it's that access, right? Like if it's on the news and you're trying to buy the news, it's already in the price. Someone else has already bought it. So
yeah, I don't even watch the news still. So
there's no reception down in Torquay. It's just drum circles.
easy on the Torquay locals, mate. They'll come for you.
So let's talk about. Your style of investment, my preferred style of investment as well is quality, right? So we look at
quality at a reasonable price.
Quality at a reasonable price.
There's no point buying a great quality business on 60 times earnings, right? Yeah. Like you're probably not going to get your money back unless that business is going to grow dramatically and you think there's material change in operations. So
there's been examples of that, particularly in obviously like the Magnificent Seven over the last 10 years, where those businesses have been high quality, high free cash flow, low debt businesses that have also achieved significant amounts of growth, but they aren't the norm in that space.
Yeah, I think as well, you can't, it's not their quality. It's not the quality factor that's driving up some of those stocks.
Mm-hmm.
It is AI. So let's call a spade a spade. It is the potential cost out and earnings upgrade or profit up increase as a result that AI can provide to some of these businesses. And in others, like your Nvidia's your favorite stock deal, it is the seemingly insatiable demand for these things and the extrapolation of that insatiable demand out to an investment time horizon that's beyond yours and my lifespan. So I don't know, whether those stocks are going to go up, down, or sideways. What I can tell you though is that they're pricing in a future that is a long way away from today.
Yeah, I think probably not working on the AI. I was probably thinking more about like your Apples and your Googles from the mid 2000s through
I
to
think
now.
That was better. It's a better example. Yeah.
So not talking about AI because that's obviously in a lot of circumstances very very frothy and very very top heavy at the moment in terms of earnings. But thinking about those businesses that were very high quality,
they still
Apple,
are.
and they still are. But for Apple to get a 10% return on investment now, it has to make like $100 billion or something stupid, right? Like
I was waiting for you to do the math. Look,
Apple's almost $1 trillion, I think.
Yeah, it is. But the point is that you need to be thinking when you think about quality. It's more than just understanding the historical balance sheet and looking at last year's annual report. and being, well, the return on equity is this, the return on capital is that, debt levels are here, and therefore it's good. You still need to understand valuation. You still need to understand how that business is priced relative to itself historically, relative to its peers, and then think about its competitive positioning today and get into the future. It's still, all the normal stock picking stuff still applies, right? Mm-hmm. It just means that, now let's take an example. Credit Corp, ASX listed company. Now, some would argue because it's a financial, it's chasing around people for their bad debts all around the world, and it has bought a couple of things over the years. It's not the highest quality business, and I probably agree. It's a pretty high quality business. It's a good business. It's pretty good quality business. Share price is off, 25% over the last 3 months or so, for a range of reasons, mainly nothing to do with Credit Corp itself. And I think...
Is it based on fear of significant amounts of default pending?
Yeah, I think that's part of it. I think the other part of it is a general aversion to non-bank financials sort of globally at the moment. People are tending to go to the banks a bit more. It's why CBA is on an all-time high PE. So I think it is also a bit of a trend in capital allocators and how professional investors are investing. And I also think it's a fact that due to relatively conservative management at Credit Corp, they were conservative during the COVID crisis.
Yeah,
and they weren't sure what their bad debt profile was going to look like. They weren't sure what the impacts were going to be. They raised money. They probably over-provisioned, and as a result, their earnings have been pretty flat for about 4 years. And so that stock's derated from 20 times earnings to 10 times earnings. And it was a $26 stock, and it's probably a $14 stock now. Was as low
It's
as
interesting
12.
though, because you're talking about this company, although it is a quality business, perhaps underlying, but you're talking about it like a value pick. So this is where all these factors, they all mesh together, because you're talking about finding a business that is undervalued based on its quality.
Everyone's a value investor. Everyone's a value investor, bro. Because if you're not a value investor, you're not making money. You've got to be able to identify that something's undervalued. So therefore, you are a value investor.
Are you saying that Warren Buffett's way of investing is actually got something?
Warren and I
are you saying that value investing is
no, I'm saying
right?
I'm saying if you want to take investment advice, don't take it from Warren Buffett. Take it from me.
So that's because anybody who is listening to this podcast probably doesn't have the money to be going directly to Berkshire and investing their money. But that's
why
okay.
not? Why not? I say. But anyway, my point here is that Credit Corp has not delivered the kind of growth that it has historically delivered. It has not delivered the type of returns on capital that it has historically delivered over the last 4 years. And as a result, the market's derated it. And correctly so. I'm not going to pretend it's not justified. My view, or our view at Seneca, is that management team who've been able to deliver, 20% sort of return on capital over a very, very long period of time are going to, guess what? Go back to delivering 20% return on capital. Now, if you're smart, you'll realise that the minute that it looks like they're going to do that, the market will price it in like it's almost a certainty that they're going to do that, and most of the easy money will be made. The slower, less adept investor will wait until they can demonstrate it, and then they will make the last 2%.
The slower, inept investor.
Investor. Yeah, that's the one I was looking for.
Less adept.
Less adept? Inept?
What time is it? Is it like 8 o'clock that we're recording?
I need a drink. It's Thursday. I need a drink.
My bedtime.
I need a drink.
It's Wednesday, mate.
Is it? I thought it was Thursday.
I hope it's not Thursday. I've got places to be if it's Thursday.
Far out, man. This has cooked me this week. So, yeah, anyway, the investor who's not as good would wait. And so, our view is that there's been a couple of little green indicators coming up out of some of the competitors, and we think that's a good idea. You get to buy a quality business at a really reasonable price that you wouldn't normally get to buy it on. And we're going to back the business's quality, historical quality, in to mean revert. Now, we might be wrong.
Okay.
Maybe the business is structurally impaired. Maybe we're buying the equivalent of a taxi the week before Uber comes, but probably not.
Probably not. I mean, people got to pay their debts eventually.
Well, hopefully, as long as they pay them to Credit Corp, I don't care.
All right, so can you give us one more, perhaps before we wrap up? Another one that springs to mind, and I think you and I have talked about this business a number of times, whether it's on this podcast or elsewhere. But it's a business I really, really like. It's James Hardie.
Yeah, it's a good business, really good business.
Quality. Am I on the right track?
Yeah, you are 100%. We just bought it recently.
Yep.
And again, the way to buy quality businesses is in periods of cyclical earnings weakness, because all businesses to a degree or another, and James Hardie is reasonably cyclical, are cyclical. So, they're going to have periods of higher profit growth and periods of lower profit growth and even negative profit growth. It is no different to any other business, any other normal private business. So, James Hardie make fibre cement products for building. They're mainly used in the renovation market, and the main sort of swing factor is the US. Fibre cement is winning market share and has been winning market share since 2005. It's over doubled its market share in the US. So James Hardie's been riding that tailwind, and we think that tailwind's going to continue. And James Hardie's going to continue to benefit from that as the market leader in that particular product. In the short term, what's happened is again, COVID, building, interest rates, cost of living, blah, blah, blah. People aren't spending as much on their house. And the intention to spend money on home improvements has fallen from a 76% high in May of 22 to a November 23 low of, I think, 46 on the UBS survey that I read. So, to me, that's a cyclical low in earnings at this point in the year. And management just came out recently and gave some, can I say comically, but like borderline laughably conservative guidance, in my opinion. Markets, all the analysts have downgraded, everyone's re-rated, everyone's got bearish. And to me, it just screams like a business that is going to beat at this result or maybe the next result. And I think gives you an opportunity to buy a business on really reasonable multiple. I think it's on like below average EV to EBITDA multiple at the moment. And is down 23% over the last, quarter. You just don't get a chance in stocks like James Hardie on those kind of terms very often.
Do you think there's been a significant increase in the cost of materials for building? And a lot of my clients will be upgrading their house, renovating at different stages throughout their throughout their financial journey. One of those things that we're noticing at the moment is that people are sort of going and getting quotes for renovations, and they're, in some cases they're double what they were 3 or 4 years ago. Do you think that obviously James Hardie were a benefactor of the increase in that and being able to increase margin over that time period? Do you think that comes back at all for people out there who are renovating? Do you think that cost of materials is going to, drop over the next little while, or it's going to stay the same, or even potentially get higher?
It might stabilise. It might go down a frac. I don't think it's going to come down a lot. I kind of think of a lot of this inflation that we've had, it's been supply side, which means that everyone's incurred the costs kind of relatively equally. And as a result, the things that were driving inflation were commodity prices and freight. Well, everyone gets whacked on commodity prices and freight because it's supply side. So I don't think like wages, once your wage goes up, it's, if you're a casual worker and your wages go up a few dollars an hour, it's very hard for them to go back down again. Wages are sticky by nature, and I think
some of those costs are going to be sticky as well.
A lot of these costs in industries where you're not buying commodity product, i.e., you want to use James Hardie fibre cement because they're the best. It's the best fibre cement and blah 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 blah. Market share, moat, all the good stuff. Well, you're probably not going to see a material retracement in prices. Now, would you make the same thing about generic office square meterage, or would you make the same argument about health insurance? Well, I'm not sure. It may be things that are more substitutable, things that are more discretionary, things that are maybe being more disrupted could change. Not saying health insurance is, but in the sense of office space. So I just think that James Hardie product, building material product, it's got a brand, it's got an ability to protect its pricing, and as a result, probably expand its margins in that scenario. Yeah,
no, I tend to agree, but it's good to get that bias of those prices.
Look, if you want to hedge your renovation costs, go out and buy a few James Hardie shares, and they'll help you.
yeah, that's right. Mate, I think we might give it a wrap there.
I think I need to go have a beer. I feel traumatized today.
Yeah, or an espresso. I don't know what it.
Too late for an espresso for me. I'll be up till midnight.
Aren't you always on Perth time, mate? Isn't it? No,
I think I'm gonna go make myself a gin and tonic. I think it's that. It's that kind of evening.
Get over the hump day. It's one of those evenings.
It is, mate. Well, look, really enjoyed that one, mate. Apologies to everyone for having to listen to me rant on, but we can't talk about financial planning all the time. And
that's right. That's right. We can't, because we'll run out of things to talk about. But I enjoy that. I enjoy that factor thing. It's something that we deal with fund managers a lot, and it's one of the most fun questions, I think, to challenge them on. And the more we can talk about it, the more content I've got to go back to them and say, well, is that really what you do? I think the better.
Well, I agree. I think we'll have to get a the king. I'll call him the king of quality on. Nick from Fairlight can come on and talk about quality accounting treatments till the end of time and bore everybody to death. But look, let's wrap deal. Have a good week, mate. I will chat to you. I don't know whenever we record next. I don't know when it is.
Whenever we record next,
in the diary.
Big love, my friend.
See you, mate.
Speak to you soon.
Bye.
Bye, mate.